Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, December 19th, 2018. In this video, I want to do something a little bit different. I want to take a look at the bigger picture. So what we'll do here is I have a watch list of about 40, it's a total of 42 different indexes and sectors. There's also bonds in here as well, only a couple bond ETFs or bond rates. So it's mostly individual stocks and stock sectors within the stock market. And so what we'll do is we'll go through the charts in no particular order, just however they're sorted here. And what this does, it'll help give a bigger picture. This is why I often visit the weekly charts. It helps formulate the bigger picture where things might be going, and sometimes you might miss, if you're focused on the 60-minute or daily charts, you might miss some key trend lines, support levels, or other developments there. Before we do that, just a quick overview. I've covered the broad markets, quite a bit lately, but the bigger picture is this: we have potential, still not confirmed, but nice potential bullish divergence here, positive divergence as the market falls to key supports. You have the lows from back here, the February 18 low, and the subsequent low was a little bit above that in April of 2018, earlier this year, and we're there. So oversold at support with divergence, despite with a clearly bearish trend. Don't get me wrong. So I've shared my thoughts lately. I expect the Fed will come out, or at least the market will interpret whatever the Fed says is more dovish than already priced into the market. I think we'll get a rally. Some of what goes into my thought process, just collapsing oil prices. Oil is one of the biggest cost input to the economy. That's very deflationary. That gives them room on the inflation front. And remember, they have dual mandates: control inflation and then price stability. Price stability is, here's the thing, and I don't want to digress, I want to get into these charts, but let me just share this. I've seen this many times in recent years since quantitative easing started in this big, huge money printing party where the Fed started to get hawkish, talking up the big talk about rates increasing. And there have been a few instances where that kind of reached a fever pitch or crescendo where all of a sudden that was it. The market couldn't take it anymore, and the market threw a hissy fit. And I've seen it time and time again. The market threw a hissy fit, and the Fed backed off. They backed off their hawkish rhetoric, and so therefore rate hikes that were expected to happen didn't happen. Things happened more gradual. And then the rally resumed. Now, what makes this time different is it's not just the stock market. For the first time in decades, and I've covered this quite a bit recently, we've seen year to date cash outperform every other asset class. Everything has dropped for the most part this year. Stocks, bonds, cash. Stocks, bonds, most commodities, various commodities, including oil, ag commodities, and various types of bonds. So when you have everything falling, I'm sure that has the Fed even more concerned. Yes, we have Powell at the helm now, but it doesn't matter who it is. You must be concerned when everything is falling. This is a credit bubble popping. So therefore, I think they're going to probably back off and hey, you know what? Here's the thing. Regardless of what they say, let me just say this now. That's not important. What is important is the market's reaction. And so before I get into the charts here, as I always say, during highly anticipated FOMC rate decisions, meetings like this one, be careful because the initial reaction at 2 p.m. once they release a statement and whatever they're going to do, they're going to hike a quarter point or not, you're going to see the market rip and dip. And it's high frequency trading, it's algos. You cannot beat those machines. They're going to go up. And my experience is you get something like this: a sharp rip up or down initially, followed by another fade of that. So be careful. And then sometimes the subsequent rip or dip is also faded. So my point being, more often than not, it's not the initial move that sticks, or at least you're going to have some back and forth. What does that mean to you trading? Well, if you're running tight stops, they're going to probably blow your stops in either direction, whether you're long or short. So I tend to, go in light. If you're not aggressive, stand aside. If you're not an aggressive or a nimble trader, stand aside. If you want to take a small position, that's what I've been doing, layering into longs in anticipation that the markets will rise today and after the FOMC meeting. And if I'm wrong, I'll know I'm wrong, not immediately afterwards, but either at the end of the day today or tomorrow. And I also want to say this: there's just as I go through these charts here, you'll see a lot of key sectors and indexes are at support, with some being just above. So I'm very open to the possibility of just one little flush out move, minimal downside. I'm talking 2 to maybe 3% in the equity markets before a reversal. That is my preferred scenario. Most important, you have to understand that if I'm wrong, I can be very wrong, because the markets are sitting on a very precarious, technical cliff, if you will. A lot of key support levels, many sectors. Being wrong with the volatility the way it is means you can easily, in the broad markets, lose 3-5% in a day or two with the way the market's moving right now. And it cuts both ways. We get a rally. I'm talking, as I shared this morning from where we closed yesterday, a rallies of over 5%, about 5.3%. And I can certainly see if that continues, if we get some really bullish price action the next few days, I can see a 10% counter trend rally here. But at this point in time, I'm viewing any rallies as a counter trend rally, bear market rally, even though we're not technically in a bear market yet. I just based on the technicals. So, but anyways, yeah, if I can get double digits in a few weeks in the indexes, I'll take it. You look at individual stocks, you can usually do three times that, or the best looking sectors. So that's what we're going to do in this video. Go over my watch list of about 40 something sectors and indexes, and we'll go from there. Okay, this wasn't the intent of the video, but I just had a price alert fire off on this one, ALO. I don't even remember setting the alert. I must have had it so long, but it's on this trend line here. It looks like it's just starting to crack above the trend line. Just wanted to share that. Let me get to gold in a second. I think gold is it's doing well today. It's up pretty nice. We have an official long trade on gold and GDX, but I may close those out earlier, at least GDX early. I'm thinking we may get a pullback here soon. But let me get to the individual sectors, and I'm going to go through these quick, guys. I'm going to talk fast. And I'm only going to stick to the weekly charts because there's just not enough time to go through daily and intraday charts on 40 something. And if the video is running too long, I'm going to cut it short and we'll do part 2. So we're going to dive in now. Again, this is just a look at the bigger picture because a market is simply a sum of its parts. So if we look at the various sectors and things that really drive the market, for example, this isn't a sector, this is USO, it's crude oil, but it has a huge impact on obviously the energy sector, and the energy sector is a big component of the S&P 500. So, and also we'll get to airlines, for example. That's airlines and transportation companies, trucking, all that. That's one of their biggest costs as well. So what's going on with USO? Well, fuel prices crude prices have crashed a lot like they did back here in 2014, 2015, and this is one of the reasons I think the Fed will come and really back off. They've already started to back off. It's expected when the stock market started to fall, but this is further reason the Fed is probably going to soften up their rhetoric on future hikes. So what I see here, I see USO at support. There's a big basing pattern here, multi-year basing pattern, but you can see I have a support level around 965 that we hit yesterday. So I think the downside's minimal at this point in crude. It could certainly go to the lower end of that range, but this is one of the deepest oversold readings that we've had in years. And either way, at support, I just want to point that out. Extremely oversold. Certainly wouldn't be shorting crude here. Now, I didn't think we'd drop out of the range that we were in recently, but we did. We broke below it, and we had a thrust down. So the risk reward, I think one of two things. We'll either stabilize here, stay low for a while, or get a little bounce. But again, I'm not doing to time an entry on a trade. I need to look at the daily and even intraday charts. So what this is not really about timely trades, but it may show you some sectors that stand out, and that's what I wanted to do. Any that do, I will post as either official or unofficial trade setups. All right, so let's just move through these quicker. XAL, airlines. This is the airline index, XAL, Amex airline index. There's a nice uptrend line, bearish rising wedge, like so many things. It's a common theme among most sectors and the indexes is we had on the weekly charts. We have long-term trend lines. Some are the entire bull market trend lines. Some are just multi-year trend lines, but they terminated with divergent highs, rising wedges, breakdowns, key moving averages rolling over. Uh, a lot of these charts have shifted. This is a problem I've noticed with TC2000, this charting program lately, that a lot of my trend lines are just disappearing or moving. I'll have to contact Worden Brothers, see what's going on there. But there is some support right around here. I see reaction. So we're at support. There may be a trade there to make in the airline, especially with fuel, which is their second largest cost, right behind salaries. So this has to be a boom for the airline sector. The big drop in fuel prices. So that's something we'll be looking at soon, but I'll have to look at the daily charts and the individual airlines themselves. XOP, XOP, I really had a trend line right here. Again, everything's shifting around recently on these charts. We overshot it recently. We had a trade on this. We were stopped out for a small loss, I think about 4% or less. And that's the thing. I will all day long take shots when it looks like an objective long entry. And you, in this market or any market, you just keep your losses small. So nothing ventured, nothing gained. We stopped out for minimal loss, 3-4 percentage points. And if we can snap back above here, see, I'm viewing this as a most likely a momentum fueled overshoot. If you followed me for a while, you know that term. I made it up, but it's what it is when you have a security that is falling very fast, a near vertical plunge, it is more than common to see it overshoot a support level with that downward velocity, only to snap back above it afterwards. I view the analogy, imagine a pitcher throwing a 90-mile-an-hour fastball. The catcher's glove is going to snap back when he catches that ball and then probably spring back to the point where he was holding it before the ball hit it. That's momentum. That's the velocity of that ball, the force of that ball carrying the glove backwards and then snapping back. So we'll watch the XOP. If we can snap back above there and regain this level, and keep in mind, these are weekly charts. The week isn't over yet. We broke this intra-week, but we could still close back above it. And if so, then that would have been a momentum-fueled overshoot, and we might get another swing trade up here on XOP. As of now, it's under support. So again, I would have to look at the daily and the weekly charts to decide, or daily and intraday, to decide whether or not to re-enter that one. XRT, these are retail stocks. Again, another chart where one of my lines has disappeared, so at least you'll get to see how I annotate these charts and what I'm looking for. And I try to point that out. I don't just place lines randomly. I see reactions. A lot of reactions, give or take, on that level. Not the best defined support level, but again, so we overshot it a bit, and so that puts it XRT at a precarious or bearish technical posture, but if it can snap back above, maybe a trade. Not one of my favorites, let me say that now. I think we're early stage, late stage bull market, early stage bear market, retail stocks. I have pretty high degree of confidence that whether we get a kickback rally first or not, XRT is coming down to at least this 3770 level within the next 6 months or so. All right, next one up, XLE. This is another energy sector ETF, the bigger one, bigger of the two. And this is mostly Chevron and ExxonMobil make this one up. Same story. This is a pretty decent support level. You can see we have quite a few reactions around that level. So whether or not this proves to be a momentum-fueled overshoot, time will tell. Like everything else, the longer-term outlook is ugly. We had a nice, well-defined uptrend line, a divergent high at resistance. A lot of resistance there, and that's where we failed. Numerous attempts to take out 78.50, and then we broke trend line support. So again, this is not as if this wasn't priced into the charts. The $1 million question is, do we get a bounce first? If we do, I would say just eyeballing this chart probably up to around that 65 area, and then ultimately before the bear market, if that is what this is, has run its course, we'll probably come all the way down here. So there's plenty more downside. It's just a matter of, do you want to game a bounce, which could be double digits. So if you're a swing trader and you're active you can game a bear market or a downtrend very successfully and profitably. Here was a bear market in energy stocks, and these rallies, these counter trend bounces were, I imagine each of these were probably double digits. So this is swing trading. This is just investing or trend trading where you short and hold, but you don't want to short right here. If you don't like to game counter trend bounces against a primary trend like a downtrend, then what you do is you wait for a kickback rally to about that 65 level, then you put a short on the energy stocks for your next swing down. Again, that's up to you. XME. This is the S&P Metals and Mining ETF. It's not the gold miners. This is the industrial miners. Copper, nickel, aluminum, and such. There's a pretty ugly chart, breakdown, back test, and it's fallen down to support. I need to lower that line. There's support there closer to about $28. So we overshot it just a bit. Maybe it snaps back up, and I think most things will. Keep that in mind. If I'm right on the market and we're going to rally now about 5 to maybe 10% from here, with whether or not we get one last thrust down of 2 or 3%. If I'm correct on that, most everything will rally along with it. That's, I think, safe to say. Again, if things that are highly correlated to the stock market. EEM, emerging markets, downtrend line to watch right there. EEM has a pretty well-defined, very powerful support level. I shouldn't say well-defined. It's not well-defined, but it is. It's been tested many times. I'm circling all these reactions here. Reactions. And so this is a big support zone with a lot of reactions for going back. And remember, these are 10-year weekly charts. So we recently hit the top of that support zone. And, to me, it's a matter of, do we come back down, continue to maybe go to the bottom or in the middle of that support zone, or is that enough? Either way, let's watch for a impulsive break out of this downtrend line right here. You can see there was a failed intra-week break, and this is important. If you are going to trade using these weekly charts to confirm a trade, you want to wait for a weekly close below or above your support or resistance level. That's all that matters when trading the weekly chart. So that is not a buy signal there on an EEM. It was an intra-week break, but the candle was red. It means it closed back down here. So we've yet to break out above that downtrend line. XLB, basic materials, looks like it's clinging to the bottom. Here's a support zone I have right there, 51.17 up to about 52.32. Chart doesn't look great. Let me just say that. Not one of my favorites, but like everything else, if the markets bounce, maybe we could bounce here. And if not, I do believe most likely we're in a new bear market, and so you can see some of the targets. I think minimum over the next year, or let's say the next 6 months or so, we come down here to 45.62. But I wouldn't be shorting here. We're at support right now, coming off oversold levels with some potential divergence there on the RSI. You can see the RSI is making a higher high with prices making equal highs. So I wouldn't short it, and not one of my favorites for a counter trend bounce either. So let's just move on. XBI, this is biotech. This is the same sector that there's a few biotech ETFs I track, but this one is the same as LABU and LABD for those of you that like the leveraged ETFs. Those are 3-time long and 3-time short of the S&P biotech sector. Same story as before. I pointed this out back in 2015. I called, bear market coming in the biotechs right here, and we were able to short it. We used LABD, I think, as our proxy, and caught a good part of that initial thrust down. Very profitable trade, and it's wash, rinse, repeat stuff. I don't want to oversimplify it, but this one was pretty clear. Biotech sometimes, they just trade well. Look at these trend lines. You have this was the one I focused on last. And again, better when you have a divergent high. Not a necessity when you look for a top on an index, but when you have negative divergence like you did back then in 2015, and you had the divergent high here, followed by a trend line break, followed by a break of the 200-day or 40-week moving average. And so to me, this looks like the initial thrust down To support, a pretty well-defined support level. We hit it once. We already bounced once, so I'm a little skeptical here. The PPO is pointing down. That may be it for the bounce. I don't know if we'll get another bounce or not. Either way, your next sell signal comes on a solid break above that. I'm sorry, below solid break below the 7250-ish level. And I don't see, I could certainly add, I will add another support. Next target would be there's some support right here. I could add a lot of lines to this chart, and the goal of this video was not to identify, specific entry points and targets right now, but you can look at these lines. Some of these other lines have been here for years, so don't just ignore the ones. Just pay attention to those nearby if you're looking for some longer term swing targets on the biotechs. Okay, looks like I paused and didn't hit the the unpause button. So I think where I stopped, well, let me just go over this real quick, was a potential scenario. I added a resistance line here. For those of you that are still in TLT that have given it some room, because I did state that, longer term I was bullish, I see a pretty decent support level, I'm sorry, resistance level here at 122.72, give or take. Um, so if we do manage to break out now, this is certainly a possible scenario. We'd get a run up there. That would give those long another an option to exit, because I would expect a reaction there, a pullback. And one scenario I could easily see happening would be a pullback to back test the wedge or the downtrend line, and then a thrust up to that longer term target I have around 128.56 or so. Remember, that's also a back test of this uptrend line, as well as a very decent resistance level. So one or two. I think we either pull back here now and then go on to breakout, or we have a little pop up to about 122.70 and then pull back. But either way, I will be looking to re-enter TLT when the time is right. All right, we're going to wrap it up here. And again, any of these sectors that stand out, I will follow up with part 2 with the remaining sectors and indexes. And anything that stands out, I'll post some charts either on the front page and or within the trading room. This has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.